Hi, I'm Corey. I'm a CPA and subject matter expert in financial accounting. And in this video, we're going to discuss the concept of common size financial statements. We'll start off with a brief discussion of what common size financial statements are. Next, we'll dive into the role that they play in assessing a company's performance. And finally, we'll tie it all together with some specific examples. The ability to assess an organization's financial performance is crucial to managers, creditors, and investors. So let's get started. Imagine you were going car shopping for a new Toyota, and the car salesman was trying to compare its capabilities to that of a Ferrari. That wouldn't exactly be fair, as it would be like comparing apples to oranges. It would probably be more effective to compare cars with similar specifications in the same price range. Now, it's similar for investors that are comparing the performance of companies to decide where to invest their money. They do this by analyzing the financial health of each organization using the financial statements. But how can we level the playing field when comparing larger organizations to smaller ones? You guessed it, common size financial statements. This tool allows us to compare apples to apples and make more accurate assessments when comparing companies to each other. Understanding how to analyze a company's financial information to determine their financial health is crucial for all users of the financial statements. But to do this, we first need to understand the role that these financial statements play and the tools that are available. One of the key purposes behind financial statement analysis is to help users make investment decisions. Creditors and investors need to make these types of decisions regularly and rely on a company's set of key financial statements, including their balance sheet, income statement, and statement of cash flows to gather critical data. Financial statements help users understand the profitability, liquidity, and solvency of the organization. An effective way to analyze a company's performance is by comparing their financial results to other competitors in the industry. And common size financial statements are the most accurate way to do this. Common size financial statements, otherwise known as vertical analysis, present amounts in the financial statements as a percentage of a particular base number. As an example, common size income statements report expenses or net income amounts as a percentage of sales. Common size balance sheets, on the other hand, usually report each type of asset as a percentage of total assets, and each liability and equity balance as a percentage of total liabilities and equity. Each item on the income statement and balance sheet are analyzed line by line and are expressed as percentages using the following formula. To get the percent of an individual item, we take the amount of that individual item in dollars, and we divide it by the amount of the base item, and then multiply that by 100. Let's look at a quick balance sheet example. A company had an inventory balance of $20,000 reported on their December 31st balance sheet. Their total asset value was $100,000. Remember, when producing a common size balance sheet, the base item for assets is always total assets. Therefore, in this case, we would just take the $20,000 inventory value and divide it by the $100,000 total asset value for a result of 20%. This percentage is a more effective comparison tool than the raw dollar value alone. Now that we understand how common size financial statements work, let's clear up a common misconception. Some users of financial statements believe that they can always assess two companies' overall profitability by comparing their net income amounts. However, this is not always the case. For example, let's compare two companies in the manufacturing industry. ABC Company earned $1 million in profit last year. One of their competitors, XYZ Company, only earned $100,000. Now, in this case, it would be tempting to conclude that ABC Company had stronger profitability. However, what if ABC Company is substantially larger with operations all over the world, while XYZ only has a single location? Looking at the dollar figures alone fails to take into account the size of the two organizations and is not always a fair comparison. Common size financial statements allow us to level the playing field and produce a more accurate comparison. Let's take a look at both of these companies' income statements to get a more clear picture. Like we just discussed, we see that ABC Company has $1 million of profit, which is 10 times the amount of XYZ Company. Let's go one step further and put together the common size income statements to see if that gives us any more information. Remember the formula to calculate the percentages from earlier. We're expressing each item on the income statement as a percentage of the base, which is always total revenue or sales dollars when it comes to the income statement. For ABC Company, if we take their total expenses of $9 million and divide it by their total revenue of $10 million, that gives us a result of 90%. This tells us their expenses account for 90% of their revenue. If we do the same for XYZ Company, we see that their expenses only make up 52% of their revenue. Even though these companies are different sizes, we can now make a more accurate assessment of their expenses. Generally speaking, the lower the percentage of the expenses, the better. Let's look a little further down at the overall net profit percentages. Remember, investors are usually looking for companies with higher profit margins because this means the company is keeping a larger percentage of profit in their pockets. When we look at the two companies here, we can see that even though XYZ has less profit, when it comes to total dollars, they're much more profitable based on their size, keeping 48% of the revenue in their pockets in comparison to only 10% for ABC Company. What this means is that for every dollar of revenue that ABC generates, they're keeping 10 cents in their pocket after paying expenses. However, for every dollar of revenue that XYZ generates, they're actually keeping 48 cents in their pockets. While we may want to do more analysis, based on this common size analysis alone, XYZ Company is showing signs of being the much more profitable option. And that brings us to the end of this video. While there's many tools that users of financial statements can use to make decisions, common size financial statements are one of the most effective ways to assess an organization's financial health. Understanding these topics gives users of the financial statements the tools that they need to make smarter business and investment decisions. If you're interested in learning more about this topic or many others, please feel free to check out our additional videos on many more related topics.